Today we are going to talk about some of the basics involved in recording transactions. And first we're going to talk through these four items and explain their uses and why they are important in accounting and how they help us to record financial transactions. The first is source documents. The second is the chart of accounts. The third is the journal. And the fourth is the ledger. The source documents are the things that provide us the evidence from which we can record transactions. They would include things like a bank statement, a bill of sale, checks, either checks that we receive in the mail, maybe from a customer, or checks that we write to a vendor. We could have a deposit slip, an employee's time tickets or time card. Those represent the employee's time. That would be another source document. We have invoices and receipts. This isn't an all-exclusive list. This is just a sample list. And in most accounting textbooks, they don't dwell on these too much. They talk about, you have a certain transaction, you buy something on credit, or you make a sale on account. But these are the actual things in business that you would be receiving or generating to initiate transactions. The chart of accounts is a listing of accounts that a business uses to record transactions. So on an accountant's first day on the job, they would get a chart of account for that business telling what accounts they commonly use and to reference the exact name when they are recording transactions. They are listed in order by kind of categories. The first is going to be our assets. That's going to be the beginning of your chart of accounts. And you would have things like cash, supplies, and equipment included in your asset category. Then we have our liabilities. You would have accounts payable, where you buy something from a vendor on credit and you have a debt associated with that until you pay it off, or a notes payable. The third category after the liabilities would be our equity account. We talked about Jim Smith Capital previously, and so that's an example of an equity account. If it was a corporation, we would have stockholders' equity, retained earnings, and some other items in there. After the equity, we would have our revenue account. Any kind of sales accounts that we have, we would include that there. And then lastly, we have our expenses. For example, wage expense, rent expense, utility expense, any kind of things that were consumed in the process of generating revenues. The journal is called the Book of Original Entry. This is where the transactions are first recorded for a business. It is in a chronological order. Some folks say keep a journal or a diary, and it's, from one day it goes to the next and the next. Well, a journal's in the same fashion, and that it's going to be a chronological recording of the financial transactions that a business has. Now, while a journal is a great place to record information and record transactions, it doesn't do a good job of being a place where you can retrieve the balances. So after a couple of days of transactions, your boss comes in and he asks you, how much is in our cash account? Well, the journal would be a very good source for that. It has the information there, but you would have to go through page after page after page and look at all the transactions that affected cash to determine what your balance would be. So what we do is after we record things in the journal, we periodically post them to the ledger. And a ledger is taking all the accounts from our chart of accounts and it's listing them in account number order. So again, our assets are going to be first, then the liability accounts would be next, and equity, and so on. And it shows within those accounts, it's going to show each transaction affecting that account. So for instance, in our assets, the first account we're going to come to is our cash account. Well, within our ledger, it's going to show all the increases to cash we had, where we received money, and then it's going to show all the decreases of cash where we've paid out money, and then it'll have the account after that, and it's going to show the increases or decreases to that account as well. At the end of each account, they'll have an ending balance there that'll tell you, okay, what is your ending balance after all these pluses and minuses that occurred during the period? What is your final ending balance for that account? So those are the initial documents that we're going to use in accounting, and I think it's important to understand kind of the basics and how they each differ and how they're interrelated.